Hey, what's going on, Refi Nation? John here from Refi DAO. I am super excited to bring to you a conversation with a panel of venture capital firms in the refi space, actively investing to regenerate the earth using the power of Web3 as a global coordination tool. We've got Ed Walters from Allegory Labs, Kristen McDonald from Eniac Ventures, and David Rodriguez from Draft Ventures. Each of these investors has a very particular lens on the refi movement, have actively deployed capital, and are supporting some of the top founding organizations in refi to grow and scale business models that address climate change, biodiversity collapse, and the complex web of crises intertwined. If you're new to the space as a founder looking to raise venture capital and aren't sure if it's for you, you want to learn more, this is a great place to open up the conversation and hear about how VCs work, the expectations for investing in particular companies, the kind of returns they're looking for, and whether or not VC is the right fit and what other options are available. There's some nuggets of wisdom scattered throughout. I hope you'll enjoy the conversation. It was super fun. It was a bit of an abrupt end towards the end because we broke into breakout rooms so we can have conversations with smaller groups. But this is the beginning of a series of chats that we want to cross-pollinate different actors in the refi space and see what surfaces as we discover what it means to regenerate the earth. Thanks for your time. Hope you enjoy this one. Thanks, Ed. Thanks, Kristen and Dave, for being here. Just quick intro on Ed. You're a board member at Climate Collective, which is one of the core kind of grant providers in the space. And you do see like a huge range of ventures looking at building a cellular ecosystem. And I think you were the first VC firm to raise a fund exclusively around investing at the intersection of climate and crypto. Super excited to hear from you. Kristen, I was so grateful to have you on the podcast. If anybody hasn't listened to the episode yet, it's definitely one of the top listens across both the seasons so far. Love the climate background that you have, and yeah, the kind of full spectrum. I know you invest outside of Web3 as well and have a really considerate and thoughtful perspective on evolution of the carbon market. Your biodiversity piece was amazing. And I really feel like, your contributions in the space are definitely taking it forward beyond just the capital you provide. And David here, for those who don't know, from Draft Ventures, is super active in the refi space, supporting several of the top protocols as an advisor and an investor. And you're also an amazing operator and founder yourself with previous exits of significant mention. So definitely one to lean into on execution as well as strategy. I wanted to kick us off with a question, whoever wants to answer first, but just like, what is the business model of a venture capital firm? How do you guys make money? Where are the cash flows coming from? And kind of what is the core system here? Whoever wants to jump in, feel free.
Yeah, I can jump in. And I will say, I think I was the first venture fund focused on refi, but the first piece I read on refi was actually by Kristen. She turned me on to the entire concept of this as a investable space. And I'm very grateful to you for bringing me in.
I appreciate that. Very sweet.
So venture capital has a pretty simple business model. It really, at the end of the day, is just like a simple business model. Asset management is really what venture capital is at the end of the day. The typical the structure is called 2 and 20. So it means a 2% management fee on assets under management, and then 20% of profits distributed essentially after you return capital to the fund. The investors in your fund get the other kind of the remainder, the 80%. I've worked at large venture capital funds. I've started a few small ones. That generally is the model across all of them. Some cynics say because the business model is so simple, the way to be successful is just to chase the 2% management fee and raise larger and larger amounts of capital and just hang out. I think over multiple funds, that strategy usually doesn't play out well. You actually have to produce returns.
Yeah.
And that often can be more straightforward with small funds. So I raised Allegory Fund 1 about a year ago after reading Kristen's article. I raised it essentially off of a lot of kind of enthusiasm and interest in exploring these two very big secular trends around climate and Web3. And thought venture capital was a really interesting way to, I think, in line with its mission. Like, explore big transformative bets. I think with first or second time funds, generally you need to find an anchor. So you find somebody that trusts and knows and believes in you, and then you layer capital on top of that. And so I've been an EIR at Bain Capital Ventures before, worked closely with the founders of the Cello kind of ecosystem. And they all were, I think, intrigued by this concept for different reasons and decided to anchor my fund. And I raised from other people in the ecosystem on top of that over the first few months and closed soon after that. And if it's interesting, typical stacks for small funds in the past were built using kind of outside fund administrators that would structure essentially all the docs, manage accounting, manage payroll, all of that. Now it's really easy to spin a fund up in days using like AngelList or Carta or others. So I set my fund up on AngelList using their entire platform. And I think I was up and running and making investments within 4 days of contacting AngelList, which was kind of remarkable. Past funds have taken me months to draft paperwork on and set up.
It's crazy. One thing I'll maybe add to that I think is like important as you think about raising money from VCs is that funds can either be focused on like one stage or multi-stage. So you can be doing like seed only or seed in A or seed through Series D. And one of the kind of limitations of venture is that like people are dependent on other money eventually coming in to support a company. So like if I at the seed stage invest in a company that I think is a really, really great bet, I'm kind of dependent on later stage investors also thinking that company is a good bet at some point. Otherwise, the company eventually goes under. So it's a little bit of like a funny ecosystem in that you can take these big transformative bets, but a big limiting factor is like, is this company going to hit the metrics that I need it to hit to kind of convince other people along the way that it can keep getting funding so that it can kind of survive to the end state. So that's another kind of funny dynamic that I think colors a lot of the way that VCs view investments as they are making those decisions.
Cool. I can piggyback on that as well. And I think Ed provided a good perspective of what the economics are and perspective is from an LP and investing high risk capital in a 2 and 20 structure in a diversified portfolio of companies. And I think more the founder perspective is in the consideration set, as Kristen was getting into around, when and why to take venture capital and what to expect, is that once you take a venture capital dollar from an investor, that comes in one of 3 forms typically. There's a SAFE, which is a simple agreement for future equity, a convertible debt, which is a debt instrument that converts into equity or equity. So those are really the 3 options that you take capital in. And I think the expectation is in the industry is once you take capital from a venture capital fund, you have one of 2 options on the other side of that, or one of 3 options on the other side of that, which is 1, your company goes public and you make everyone a lot of money. 2 is you sell the company, and that can be a range of outcomes. Or 3, you return capital or go out of business and return the remaining capital. And so, building a company in venture is everything between those 2 endpoints. And what Kristen was lining out is, there's a path to get from one side to the other. And that's typically raising more capital unless you can self-fund the business with profits, which is very rare after taking initial venture capital. And, to go one layer deeper than Kristen, the expectation from venture capital funds on getting additional capital into the business as you go from just starting that fund and taking the first check to a potential exit scenario is that you're growing the business at a specific cadence. And usually that's above two times growth every year, or 200% growth every year. It's typically closer to 3x growth every year, which means that you're really growing fast to raise consecutively higher and larger amounts of capital as you move towards an exit scenario.
And I'll jump in and say one more thing, then I'll stop. The other piece of that business model is venture funds need to raise new funds every, call it like 2 to 5 years, and they raise on the essentially increase in valuation on companies they've invested in. And so, at its worst, that's like a Ponzi economics game. At its best, it's demonstrating that you are in the best deals, creating real value for your portfolio and for your investors. And so, that often is where the pressure from VCs comes to raise more capital, higher rounds. It's for them to go to their LPs and sustain their own business model. And so what that means in practice is there really is a choice between raising from small funds like pre-seed, seed, Series A funds, and big multi-stage funds that manage, you know, 5, 10, $20 billion. Most venture capital firms think about every investment they make needing to hypothetically return the entire fund, right? And so if they invest in a company and they take 10% of the company, that company needs to exit at a valuation which returns 10% to the investor, which represents their entire fund. And so that math, when you think about like an Andreessen Horowitz or a Tiger Global, becomes really hard. It essentially means that your company needs to be worth upwards of 10 to 20 to $30 billion for that to make sense as an investment for them, which isn't always the case like for a founder, right? So that's where when people say, be careful who you bring on as an investor, they're not all the same. Like that's very true. Like small firms can be very, very happy with sub $100 million exits. Large firms, the math just doesn't work.
There's also a third option where you don't take any VC
What?
money. So
Kristen, no,
don't
what?
That's a very powerful option.
I love you for that. Keep going. When is it not the right thing to raise VC funds?
I think whenever you're in this camp of somebody who does not want to grow at that pace and is not needing a $1 to $10 billion outcome, I think it's right to not take venture money. I mean, think about it. Like if you build a $10 million business and sell it for $10 million and you own the whole business, like a lot of us will be very happy with that exit. If you own 1% of a business that you have to spend your life building to kind of satisfy VCs, like it's a very different vibe. It's a different equation. So I think people who are like building those sorts of businesses that aren't targeting those really, really big outcomes where you have to grow that quickly and expand that fast, I think it's great to not raise VC money. It's probably the better thing. Or industries where there's a lot of R&D, there's a lot of exploration. Like you couldn't take your product to market and have it grow 300% and hit $1 million in a year. Like that doesn't mean it's a bad idea. It might just mean it needs to spend some time outside of like the VC funding world before you port it over. So I think that.
Yeah, I don't think this is a taboo thing to say as a venture capitalist. Like I encourage often entrepreneurs not to raise venture capital when their business is not right for venture capital. And everyone on this call who's thinking about building a business, like you really have to consider what it means to be a founder and raise venture capital in terms of what your life will look like over the next 5+ years as a founder of a business that has a growth imperative of 3x year over year, that will be building large teams, that will have some of these constraints and requirements that's incumbent upon founders who raise capital. And I think the consideration set as you think through that is, one, am I operating a big enough market where I can build a venture scale business? 2 is the growth of my business, and can I grow a business as fast as I need to, which is kind of that 2 to 3x year over year over the next 5+ years of this business to get it to a scale that can lead to a venture return. And 3, what are the capital requirements of this business? Because even if you have 1 and 2 where you're operating a big enough market, you can grow a business as fast enough, maybe it just makes sense to bootstrap a business, not raise venture capital, raise some smaller pools of capital from angels or self-fund the business, and then fund the business through profits. And as Kristen was saying, there are a lot of benefits. And when you're not, last thing I'll say is that, people I think underestimate the value of optionality. And I think in taking venture capital, you're limiting your optionality. Whereas when you are bootstrapping your business during those early stages of business where you're self-funding or just arrange angel capital, you still have a lot of optionality of what you do, how you grow that business, what markets you pursue, because you don't have those constraints that I mentioned earlier around what happens when you take venture capital.
I couldn't agree more. All I'd say in addition to that is like venture capital is the most expensive capital you can take, like far and away. And it's often sold as like value add capital. Like your investors will add a ton of value after they invest. I think that's unusual as an outcome. I think in most cases they just don't do anything valuable. And in some cases, they really damage the business and like destroy value. So like, I think it's a last resort. It's only if it really makes sense. So I agree with you guys.
Nice. I appreciate your honest exploration of the space. And I think you've done a great job of laying the initial foundation upon which we can think about this. I'd love to shift to one of the kind of apparent tensions or dichotomies that I see, which is venture capital is necessary to scale, world-changing businesses in a short time frame. I think we would all agree with that it's a, fundamental source of capital that provides, an injection that isn't really available elsewhere. It's set up for that kind of risk that other places aren't. You have this kind of growth requirement, which sets a precedent for the culture of the organization, the rate at which it hires, rate at which it goes to market. And yet we have this kind of precedent with a lot of the capitalist corporations today that they leverage that growth to extract value out of their users, out of their communities, and out of the natural resources of the earth in which, these systems are being drawn upon. How do you see the balance between growth and regeneration, and how, we can deploy capital consciously, grow quickly, but also actually build a system that restores natural capital, restores human capital? This to me is an intersection I'm really struggling with, and I'm trying hard to like piece apart. I'm curious what your guys' thoughts have been in this space.
I personally think about like balancing those two comes down to not trying to remake a system all at once, and instead finding ways that play into the current system in a way that like net improves it. So like a business that is going to go out and like fundamentally change the way whatever agriculture works or whatever to be completely regenerative, it might not scale because it doesn't play friendly with today's kind of current capitalistic system. And so it's really hard to say like, let's pour money into this because it's such a great idea and it should work, because if it's not going to fit with the current system, it's not going to scale. And it's going to, even though it's a great idea, it's not going to be a really, really great use of capital. Versus then there are other approaches that's like maybe not as fundamentally different, but a clear improvement from what we have today and a clear kind of nudging of the system in the right direction. And because it plays friendly with the system, with the kind of current capitalistic system in place, like you can put money on that and it will scale and it will make a difference. And so it's constantly like trying to move like slightly over in nudges, I guess is how I think about it.
I guess a contrarian point to what I said before, what we were talking about around the perils of taking venture capital. It's also a forcing function, right? And this is, once you have those constraints and the growth imperative and what you need to do to be a venture capital company and have that type of outcome, what it does, it really forces. It's a forcing function for companies which need to reach scale. And I think when we apply the regenerative economics lens onto that, sitting in the seats we are in this refi space, as investing in this refi space, we do need to find and prioritize and accelerate and put our attention and resources into, as a space, not just as venture capitalists, into the models that are working and that are scaling. And this is both to level up our existing legacy markets around regenerative finance, but also if we're creating a new paradigm, we do need to find models that accelerate, that are growing at an accelerated pace that can reach that scale if we're going to have the impact that we want. And so I think, looking at it from, the benefits of constraints is a really valuable lens to view this as well.
I view technology as like a morally agnostic tool. I view capital as kind of the same thing, and like venture capital as a derivative of that. And at times I've been really intrigued by like the degrowth movement. I think I've become increasingly cynical about like the implications of it and what that means for innovation and how we want to reorient our society. So I think I've come to a point where like, I think system level change is very hard, to your point. I think it's easier to focus on individual opportunities that provide catalytic leverage, which to me is like what venture capital is. And so you can look at solar or wind over the last 10 years and what venture capital has done around innovating, like in manufacturing, other industries that have made those technologies like transformatively impactful to the landscape and what we can talk about now around impact, right? Like the cost has gone down by 90% of these things, and it's made the ability for us to affect change at a policy level 10 times easier as a result, right? So I'm most energized with talking about like specific examples and options that we have to make an impact. I think I get lost when it's almost too high level because these systems to me just feel too complex to understand.
I like catalytic leverage as I don't know, that's like a great way of thinking about it. Yeah. I don't think it's not systems level change. I just think that systems level change is the sum of lots of these small catalytic like leverage pinpoints that you can kind of move along that then sum up to eventually equal some level of systems level change.
And shifting the conversation a little bit towards the founder perspective, I'm curious to see what your read on the landscape is. It seemed like we had a real explosion after the kind of Clean It Out Toucan launch and millions of tons coming on chain, loads of different new founders coming into the space. Everyone was getting funded at pretty crazy valuations, left, right, and center. The bear market's hit. What do you guys see today? Where are the opportunities? Where are you seeing some exciting ventures? And, what would your recommendations be for founders who are looking to raise funds in this particular market?
I think that as you're thinking about raising in this market, like there's been a lot of companies have explored a lot of different approaches within refi. So like thinking about on-chain carbon credits, a lot of people have spent a lot of time thinking about that. And I would say as you start going to market, think about finding problems that are if it's refi based are fixed by adding that Web3 component, that it's not necessarily like gratuitous, if that makes sense. Like I think figuring out how to leverage Web3 when it isn't solving a problem that inherently exists today is like a solution without a problem, and it's really hard to raise on that with that kind of a premise. And so thinking about like what the real problem is that you're solving and why your solution is the solution that really is the right one to solve it, I think is important before you think about going out.
Yeah, I think my perspective here is that we've seen a concentration of companies investing in a few smaller, a few categories within refi, where the perspective that I have of what refi is much broader. And when we're looking across a much broader purview of marketplace. And when I say that, I think of, refi as kind of, what applying the principles of regenerative economics, almost in the way that John Fullerton described it. And what excites me about Web3 is that we have now a tool of, coordination and consensus mechanisms that can be applied in a new ways that our traditional tools and financial system couldn't dream of. And so I want to look at how we can apply these tools of decentralization, of coordination, of incentivization, and use the benefits of the transparency and compostability of a distributed ledger to affect change broader than some of the small segments that get a lot of attention, like carbon credits. And so for us at Draft Ventures, we're looking at a number of spaces. We're looking at, for example, real world asset lending, which is begging the question of like, how do we use some of these new technologies in DeFi and distributed ledgers to blend and make loans to world positive assets? And where can we apply a new type of system that actually serves the market better in these credit markets than a centralized entity, either a bank or a lender, where I'm asking the question, like, where does deal access, where do we get an access to more deals, and how do we underwrite and price risk or serve loans that we make? And we've invested in this space across a number of companies, including a company called Goldfinch, and that's in the microfinance space. A company called Gia, also in the microfinance space, lending to small businesses, and a company called Silta, which is in the PPP, public market, more infrastructure lending. Another space in refi that's, I think that's really ripe for innovation is around energy and energy markets. I think we're going to start seeing a lot more innovation there. And these are, very large markets. And I think, a third space I'll mention is, in a concept I think about is, how do we build the right primitives around refi and Web3 refi specifically, so we can create world positive action and incentives. And that's just beyond carbon. I think a lot of what we've seen today is the innovation is we have this one product that we have a global market around, which is a carbon credit. It's a very narrow product that we thought about, which is like, if you look at the 17 sustainable development goals, like this is just, goal 13 around climate. And really the carbon credit addresses like one of the issues within goal 13. And even within that, like it's so rigidly defined what carbon credit is. It has to be, you have to have baseline measurements. You have to have third-party validators. You have to have all these things to meet these standards. And yes, like there's benefits of, working within the existing system and building products for that 100%. And we're going to invest there. And, we have 17 other sustainable development goals. We have a ton of innovation, even within the carbon markets, of new things that can happen to create primitives and economic products there. I think beyond that, there's a whole new world of how do we incentivize world positive action using distributed blockchain, distributed ledger. It's going to be really exciting to see that. And I don't think, I don't pretend to even know what the innovation will happen. It's just like, I want to be in the seat where when I see the talent that's flowing through space, I'm going to be ready to help, invest in that company and help that company grow.
When you see these talented founders coming into space, what are the signals that you see, David, in particular? Like, what are the things that catch your eye and your attention that goes, yes, this is somebody I want to be talking to, just off the top of your head?
I think it's a mix of, there's a mix of things I look for in a founder. I think that there's the tension between, do we want a founder that has a lot of depth of experience? They're experienced operators, they've had successful exits, and they know how to build companies. And that's definitely an archetype that desperately want to see more of in the refi space. We have a lot of brand new energy in this space, which is good, but also it helps to have these experienced founder types that know how to operate in the venture capital system and scale companies. So I think first there's that archetype. But then there's this, the second archetype, which I like, which is like hasn't built a company, but is a highly visionary type who has the capacity to play in the contrarian space of not operating the same ways as the old paradigm and innovate beyond. And like the first time founders or second or third time founders that haven't had, a trajectory of building companies, I'll invest in those entrepreneurs either way. And I think for me, the key to that archetype is, are they capable of growth, and are they willing to ask the right questions, listen, and integrate those learnings? And so a lot of the time when I'm evaluating entrepreneurs, I'm getting a feel for those types of things, and sensing, okay, what is their background, what's their capacity, what's their skill set, and also, what's the potential of the founders to learn, to ask questions, to be humble and operate.
Just provide a different perspective. Like I prefer to see founders not lead with like refi specific nomenclature. Like my advice would be almost like, do not raise as a refi company, do not raise as a Web3 company. Like, do not use lots of esoteric concepts or words. Like it's
what?
Like,
that's what all the cool kids say, Ed. What you talking about?
Yeah. And I just, it's like 15 years ago, raising as like an internet company. Like to me, the most compelling pitches come from entrepreneurs that raise based on the solution that they're creating, right? So like, if it's around carbon markets, great. If it's around transforming real world lending, awesome. But to me, like alarm bells go off, or at least I get more skeptical when I feel like there are buzzwords being leveraged to either confuse me or to raise off of hype. So I think like simpler is better. Blockchain, Web3 technologies in the background is better. Like focus on the solution.
Yeah, because I think it's a red flag. It shows that you're like focusing more on the methodology and the technology and the exciting stuff you're building than like the solution that you're actually solving in the market. So it's like, I remember when Nori first went out for their seed, they were like one of the first refi companies before that was a thing. And it was like, you could get through like 4 like hour-long pitches with them before they would even mention that there was actually like blockchain technology on the back of it. Like that's the sort of, I think, concept that probably works best.
Again, for what it's worth, like my advice is based on what I think allows for like an easier raise. It might not be what makes sense for pitching the right talent to join. or for telling the right story to the right people. But I think for a generalized raise, that's what I've found is the most expedient.